All right, guys, it's Angelo Christian here today, coming to you another great edition of Real Estate Insider, and want to talk to everyone today about the impact of credit inquiries, because we get tons and tons of people like, hey, man, I don't want you to pull my credit. You're going to make my score go down, and I won't be able to qualify for the loan. I'm going to have a low credit score now. I'm going to have to pay, a high interest rate or pay fees, and I want to talk about this today to go over the facts and the myths, so that way you guys understand what a credit inquiry is. There's different types of credit inquiries, and there's also the amount of time that actually stays on your credit report and how it actually affects your credit. So that's the purpose today of this show, is to actually educate you and teach you what exactly a credit inquiry is, the different types of credit inquiries, and how important they are. And there's also rules around with the Fair Credit Reporting Act, the amount of time that's allowed to actually report for a credit inquiry. So we're going to go right into it, so that way you guys can know exactly what the rules are. Because like I said, so many people, they think, well, no, I don't want to get my credit pulled, because then it's going to be a hard inquiry, and now I won't be able to get approved for the loan. So, but the fact of the matter is, you actually have to have your credit processed in order for the lender to determine your eligibility to give you the approval letter, so that way you can buy either a house or a car or getting a credit card. It's a part of the process. And so there's a few different ways that, I want to actually break it down. The first thing is, there's two different types of inquiries on your credit. The first one is a soft inquiry, and you'll see all the information up here. The first one is a soft inquiry. And basically, this is like if you're going to apply for a job, right? You go to apply for the job, and they have to check your credit just to make sure that that you're not going delinquent or crazy, and that doesn't actually show up on your credit. There's no impact for a soft inquiry. All right. So whenever you go, like you apply for a job, or you work for the government, they want to check your credit, that soft inquiry never shows up on your actual inquiries on your actual credit report. And remember, there's three different bureaus for the credit. So remember, there's three different credit bureaus. There's Equifax, there's Experian, and there's TransUnion. There's three. So normally when you buy a house, the underwriter or the decision maker, the loan officer, is going to take the middle credit score of the three. So if you have like a 650 credit score, a 675 credit score, and a 700 credit score, they're going to take the middle score. They don't average them together. They take the middle score, which is 675, and that's how they determine which loan program you're going to qualify for. All right. So in this case, they would take the 675. But like I said, on the soft inquiry, that doesn't affect your score. Now, if you have a hard inquiry, that means that you've applied for credit, either to buy a car, furniture, or house. That's going to show up on your inquiries on your credit report on the Experian, TransUnion, and Equifax for up to 2 years. Okay. Now, having somebody like, let's say that you apply with us to buy the home, and we pull your credit, that's going to show as an inquiry on your credit, but that doesn't make your score go down. All right. What makes your credit score go down is if you don't pay your bills on time, right? If you're delinquent on your loans or debts, right? Or you max out your credit cards. Let's say that the balance on your credit card is $1,000, and the high credit limit is also $1,000. Then your credit score is going to go down, because it makes it look like you're being irresponsible because you're maxing out your debt. Okay. So you typically on a credit card or revolving debt, you want to keep that below 30% of the high credit limit. So if you have $1,000 credit limit, you want to keep the balance usually below $300. So then that way your credit score stays good. All right. Now, the other thing is that delinquent payments, they stay on your credit score, your credit report for 7 years. So delinquencies are not good. That will hurt your credit score for sure. And also defaulted accounts. If you have accounts that go into collection, if they go into charge off, those will also affect your credit score too. So, and they stay on your credit bureau for 7 years. And bankruptcies, they stay on your credit report for 10 years. All right. But I'm gonna talk to you about that, because that actually doesn't affect you actually getting approved for a loan, just because it shows on your credit. the thing that I want to go back to on the hard inquiries is, and I pulled this, and you're going to see this right here. I pulled this from the Fair Credit Reporting Act. So this is not just Angelo saying it. It's actually the law on how this works for the when you're let's say applying for a house, what's allowed, how many inquiries that you're allowed. And I always tell people this, that when you're applying for a home, and the credit bureaus, Experian, TransUnion, and Equifax recognize this, that you're allowed up to 5 inquiries when you're trying to buy a house. They bundle them all together as one inquiry. All right. So it's not 5 inquiries. It shows 5 inquiries, but the actual impact on the credit score, and you can read that here, that's going to be published from the Fair Credit Reporting Act. Let's say you had 4 inquiries to buy a house. Well, the modules, the reporting agencies are just they're going to score that as 1 inquiry, right? The problem is, or the issue is, what arises is if you have 20 inquiries now to buy a house, yeah, your score is going to take a hit, because that means that you can't get approved for the loan and you're running all over the place to buy a home, and you're getting denied for credit. Because most people, they don't do, 10 to 20 inquiries if they got approved for the loan, right? If they got approved for the loan, they're going to do usually, 1 inquiry. Like most people, whenever we approve them, they just do that 1 inquiry because we're the best, but you can go up to 5 inquiries for that particular sector or industry. Okay. So understand that it's 5 or less, and your credit score is not going to be affected when you're applying for that particular item, whether it's a car, whether it's a house, whatever it is. So you got to get that out of your head, because you need to have your credit checked to get the pre-approval letter, so that way you can purchase the home. Does that make sense? Okay. Because but you don't want to let people pull your credit 10, 20 times for that house or for that car, because that will drop your score. And usually after 5 inquiries, every additional inquiry is going to be about a 5-point hit to your credit score. All right. So please keep that in mind when you're applying for a house or a car or a gas card or furniture or whatever it is. Don't go crazy and let the place shotgun your credit around. You see this a lot with car dealers, or car dealers do this because the car dealer is just the dealer. They're not the actual lender. And they will submit your credit, application to, 10 lenders to shop it around, and yeah, then your score is going to take a hit. So that's the key thing, and they'll stay on there for 2 years. Those credit inquiries are actually stay on there for 2 years. So so basically, and read this information. You could also Google it from the Fair Credit Reporting Agency, and that's what it's telling you. That you can have up to 5 inquiries if you're going to go buy a car. Now, one of the things that you have to keep in mind, where let's say you're going to buy a car and the house at the same time, well, then you can have a total of 5 inquiries for the car, 5 inquiries for the house. So that's a total of 10 inquiries. That doesn't mean you need to go get 5. I'm not telling you to go and apply 5 times for something. Really, if you're happy with your lender and you're good with the terms, then you're good with them. You just need to have it pulled once. But you don't need to have it. I'm not saying to get it pulled 5 times. I don't think that's a good idea. But just get it pulled 1 time, or 2 times to see, but definitely don't go over 5 within, that 30-day window, because it's going to be too excessive. And that's the other part of this, is stay within that 30-day window, because that's going to be very important. So, the other thing that I'll also tell you is that when you buy a house, that the credit report is good for 3 months. All right. So let's say, and another thing that's very important, that at closing, when you close on your home, the underwriter does a final check. They don't pull your credit again, but they check, it's called an LQI report, where they're going to check and see if you took on any new debt. All right. So what ends up happening, let's just say that you get pre-approved to buy the home, and you go and you process the whole thing, and everything's looking good. We go and we're getting ready to go to closing. Time passes, and you decide, a week before closing that you want to buy a car, and the car payment's $500 a month. All right. Well, don't think that and be sneaky and think that no one's going to find out about that, because the underwriter will find out about it. All right. And what they'll do is they're going to check to see if you took on any more debt. And if you took on more debt, then that car payment of $500 has to go into your debt ratio. All right. And that could affect you from buying the house, because now you took on a new debt and your financial picture, your situation has changed. And because you have a higher debt ratio now, that could affect you from closing on your home. So the point is don't alter your financial situation and take on new credit until after closing on your new home. Close on the house, and then if you want to go buy furniture or a car or whatever, go ahead and do it. But don't do that during the processing of your loan. It's very dangerous unless you have enough income to support that debt. But I still don't recommend that, because you don't know, by inquiring a bunch of places, if that lowers your score. I just don't think it's a good idea. I think you need to close first on your house, and then if you want to go get stuff like a pool loan or car loan or whatever, that's fine, or co-sign for your kids. Just keep that in mind, because that's very, very important when it comes to taking on new debt. So especially when your loan's in the process of closing. So the other thing I want to go back to is there is a difference. We talk about defaulted payments between a collection and a charge-off. The way that the underwriter actually, when you're buying a house, the way they look at that, and also disputes. So with collections, if you have over $2,000 in collections on your credit report that are non-medical, they do something, a 5% multiplier into your debt ratio. So let's say you have collections on your credit bureau. Let's say that, for example, a person has $2,000 in collections that are, medical is not counted against you, by the way. So if you have medical collections when you're buying a house, we don't look at those. Some lenders or banks do. We don't count medical against you. But let's say that they're regular collections. If you have 2,000 or more, then they take that, multiply by 5%, which is $100 per month, and that goes into your debt ratio. So keep that in mind, right? That if you have collections, that will go into your debt ratio over $2,000. Now, if you have charge-offs where the lender has charged it off, that will not go into your debt ratio, right? So the charge-off, the difference between a charge-off and a collection is when let's say that you took out a credit card with Discover Bank, and it went into default. So Discover, what they normally do is they'll charge it off. They won't sell it to a collection agency. They'll charge off the debt, write it off on their books, right? And it'll show on your credit report as a charge off. So Discover charged it off, and so there it'll show on your credit as that, and that doesn't go into your debt ratio when you're buying a home. But let's say that Discover decides to sell it to Midland Credit. Midland Credit is the collection agency. So if Midland sells the debt for, let's say it's a $5,000 default, if Discover sells that to Midland and they purchase that debt, and now that shows on your credit report as a collection, well, then that will go into your debt ratio. Okay, because now that's a collection agency coming after you, and that would go into your debt ratio. A $5,000 debt multiplied by 5% would be $250 a month added into your debt ratio, and that could affect you from qualifying to buy your house. Okay, so just know the difference between those two. The other thing that I want to talk about and hit on is disputes, because for many years credit repair companies, all they do is put people's stuff in dispute, charge you a bunch of fees, and kind of rip people off. Okay, and the agencies, FHA, USDA, Fannie Mae, Freddie Mac, and the credit bureaus, Experian, TransUnion, and Equifax got smart and said, hey, we see that when you put an account in dispute, it freezes the credit score. And so that way it kind of manipulates the credit score. Because when you put something in dispute, it freezes that trade line, and now it doesn't report anymore. Okay? So when it doesn't report anymore, then it doesn't show the true score of the applicant or the borrower. So if you had something in default and you put it in dispute, and it doesn't actually show what the impact is on your credit. So the agencies and the credit bureaus wised up and got smart, said, no, you can't do that. You can't have over $1,000 for FHA in non-medical accounts in dispute. If you do, we're going to penalize you, and it's going to be a manual underwrite, which has more stringent qualifications for home approval. With USDA loans, the maximum accounts that you can have in dispute is $500. VA and conventional, it's based on the underwriter. It's solely based on the underwriter and their loan approval. But for FHA, it's $1,000. You can have up to $1,000 in non-medical disputes, and USDA, it's $500. Okay, so that means that if you just throw everything in dispute and you hire a credit repair company, and they just put everything in dispute, yeah, you have a 700 credit score right now, but all your stuff's in dispute, and you're doing an FHA loan or USDA loan, you're gonna have very stringent qualifications to get your home approved because you did that. Now, if you're a veteran or you're doing a conventional loan, you may be able to get slide and get through it. We have closed many veteran loans and conventional where there were accounts in dispute and they weren't penalized. But it just depends on what's going on. The thing that will tell you is that if most people do an FHA loan, then if they have accounts in dispute, they may have to take those accounts out of dispute, and it could lower your credit score. So sometimes settling the account's better, so that way you don't have that account there, that delinquent account. So the trick is not just always to put stuff in dispute. Sometimes you do have to settle it in order to buy your house. And now when you settle something, you can sometimes settle it for 30 cents on the dollar, 40 cents on a dollar. We offer free credit restoration, and we help people with that. And sometimes we'll get stuff sometimes we will dispute stuff if it makes sense. It just depends. And sometimes we'll also settle stuff. So it's not always bad to dispute things. Sometimes it can be, sometimes it's not. But it's something that is important that you have to know the difference. So, but I know the biggest thing, I want you guys to take these takeaways to empower you, to educate you, so you know the difference between, what's a credit inquiry, soft or hard, what defaults do, what bankruptcies do, what collections do, what inquiries do, so that way you're aware of it, so that way you can make the best decisions for your life moving forward. And that's the whole important thing. You have to be empowered, and knowledge is key. You have to learn these things. It's so important. The other thing is, on bankruptcy, just because you have a bankruptcy on your credit report doesn't mean that you won't be able to qualify for a house. It's not true. It stays on your credit for 10 years. But we have people that we do 1 day out of bankruptcy, 1 year out of bankruptcy, 2 year out of bankruptcy. People that are in a Chapter 13 bankruptcy, we can still get you into a house. So don't worry if it's just on your credit report. It doesn't mean that you can't buy a house. You definitely can. So I hope that this was great and you guys enjoyed it. My name is Angelo Christian. We're a national mortgage lender and realty. One of the largest and prized government-sponsored lenders, awarded by AAA rating with the Better Business Bureau. We lend in every 50 states. We're here to help you, to serve, to get you into your home. Thank you so much for checking us out on Real Estate Insider. Please follow us on Instagram, Facebook, YouTube. Share this with all your friends and family to educate them and empower them. If there's anything you want to see, put it down in the chat box. Hit me on Messenger on Facebook. I do respond to all my messages. It's actually me. It's not a robot. Yes, I work very hard to come out and serve. So check us out every single week. We do 3 great shows to educate you and empower you to make sure that you get all the great information with real estate, finance, and investments. Guys, I want you guys to have a great weekend. Take care. Peace out, and God bless.